entity. All right, so you'll see that tonight, you'll see that throughout every class, this duality that exists in partnership tax. And then the authors begin a general introduction, and for those who've had me for corporate tax or anyone else for that corporate tax in any other class, just generally an introduction of choice of entity. Which entity, client comes through your door, what entity are you going to choose for your client in terms of them conducting their business? And I will say this, that generally your go-to entity is going to be pass-through entity, right? Pass-through generally, unless you guys say to the contrary, at least in my experience, generally we're going to recommend that your client form a limited liability company, okay? Right? And I can open up, anyone have a difference of opinion? Generally that's your go-to business entity, right, Eric? All right? And, you know, if a client grows, good for them, and they want to at some point go public, they're going to not go public through an LLC. They're not going to have a publicly traded partnership, in my opinion. Ultimately, they will become a subchapter C. But going from LLC to subchapter C is tax-free, right? But the converse is not true. Going from a C corporation to an LLC, generally taxable, considered a corporate liquidation, and similarly, going from an S corporation to a partnership, also taxable, okay? There's code section 331, 336 that deal, even though that's in subchapter C, even those code sections, 331, 336, still apply for purposes of subchapter S. Just pointing that out. So my point is, generally, good news, your Wednesday nights, well spent, because LLCs are where it's at, right? All right, good. I want to see faces of enthusiasm. All right, so the authors talk about the pros, the cons, and I'm saying, you know, one layer of tax generally, right, is better than 2 layers of tax, agreed? So, you know, C corporations generally are not your go-to entity. I may eat humble pie in a few weeks, right, if the Trump administration and there's tax reform and maybe the corporate tax rate goes from the current highest rate under Code Section 11 is what? 35 is the highest rate. We know the Trump administration originally spoke about a 15% tax rate. I think that's a non-starter now. Most people are saying, well, Donald really meant 20 or 25%. We'll see. And that may change. Personally, I don't know if it will change. I still think LLCs will be the way to go. It'll be interesting to see if there's overtures to try to make LLC income taxed at whatever the new corporate tax rate is. In other words, if corporations were going to be taxed at 15%, will LLC income be taxed at 15%? And I said to you this was introduced in Kansas. That Kansas had low rates for business entities, whether they be C corporations or S corporations, and we may, as practitioners, all be very busy if that actually comes to be. So we'll see. Let's not speculate. All right. So the authors talk about 1 layer of tax versus 2 layers of tax. They talk about potential payroll tax issues. We talk about S corporations, and we say S corporations have an attraction. It's 1 layer of tax, but they are certainly not as flexible. They're certainly not as flexible as partnerships. In fact, I got a call today, not surprised, someone, an accounting call, and said, I just want to hear you say this. I have someone who wants to take their LLC and convert it into an S corporation, but they have different priorities with they want to know if they can have preferred stock. And you guys, and I know that with respect to S corporation, right, you can only have 1 class of stock, right? It can be voting and non-voting, but there can only be 1 class of S corporation stock. And when it comes to LLC membership interest, variations, anything you want goes. Okay, so no limitations there. All right. I said that in yesteryear, there is a lot of controversy between corporations versus partnerships, because partnerships began to look very similar to corporations, particularly with the advent of limited liability companies. And taxpayers were nervous that, gee, if they formed limited partnership or limited liability company, could the IRS come back and say, hey, you're not that, you're actually a corporation. But ever since the Treasury Department adopted the so-called checking the box regulations, that is no longer true, right? That you can be what you want to be. In other words, your client can be what he, she, it wants to be. You can, at liberty, if you incorporate, you're a corporation. If you don't incorporate, by default, you're going to be a partnership unless you elect, and you can elect to be a corporate entity. And the authors elaborate about this election process, right? Keep in mind that every time someone enters into some sort of business arrangement with someone else, that's not always a partnership, right? That if you merely share expenses, sharing of expenses don't make you a partnership. If you co-own property, that alone doesn't make you a partnership. There has to be a joint anticipation of profits. All right, so the authors go a little bit into that. And we got a taste of publicly, I said don't worry too much about publicly traded partnerships. Don't worry about trust. Towards the very end of the chapter, they talk about tax policy issues, but nothing Herculean there. So chapter 1 is an interesting chapter. It's one of those chapters that, just like in the corporate tax area, you'll probably absorb more as the semester unfolds. That you'll probably get a better handle on it as the semester unfolds. So just know that in advance. We then began a conversation about chapter 2 and the formation of a partnership. And here, we had more issues, ones that I said lend themselves easier to test on. And there's similarities and differences between forming a partnership and forming a corporation. But these code sections you guys have to get down. Okay? Got to get these code sections down. So get ready. Make sure you get these code sections down. Generally, Alicia, taxable or not? You form a partnership. I'm sorry?
No.
Not taxable, right? Generally not taxable. Everyone agree?
Yes.
Generally not taxable. Our authority E-man is what? 721, right? I was supposed to hear a chorus. I heard a few voices. I'm waiting for my chorus. 721, right? And once you know 721, again, just because, I don't know how many of you at the Labor Day picnics you guys were talking 721. I'm sure, Jonathan, if you had been at a Labor Day picnic, you would have simultaneously mentioned what code section, just because you couldn't resist.
705.
Say again, Jonathan? 705. You can't resist. It's like potato chips, right? 705. But Amar, I'm just talking about the analog in the corporate area. 1001, I understand why you're thinking that, because Amar is thinking, gee, we don't want it to be taxable, right? 1001 says all sales or exchanges are taxable, and here's an exchange. You're giving up property in return for a membership interest. So Luke, what am I talking about?
722 and 723.
Yeah, I am too, but I'm also talking about in the corporate area south. 351, right? Everyone agree? 351. I know, my brain works in strange ways, but we're talking about 351 because, right, people are talking tax-free, right? So you're talking 721, you're talking 351, and you just have to make sure these code sections are at the tip of your tongue, right? Got me? Okay? 351. Okay. So, 721 does trigger the application of other code sections, and in this case, tell us more. What code sections does it trigger as well?
772,
But just say it loudly.
722, 723.
Okay, I love it. Keep going, but why? Well, you and someone else make a contribution to a partnership, and in 721, just tell us, what does code section 722 say? Paraphrase.
So it's about outside basis, which is the adjustment.
Okay, everyone agree? Outside basis, I like it, right? That's the phraseology we're going to use. Outside basis refers to your tax basis in that piece of paper, right?
Yeah.
Right.
Yes. And then 723 refers to inside basis.
723 refers to inside basis. What basis does the partnership interest or partnership have in the property that's been contributed, right? So it all fits neatly together. Everyone's got to understand that these code sections are all one, right? 721, 722, 723 all fit neatly like a piece of puzzle. Agreed?
Yes.
Okay, so we had those 3 different code sections, but Jesse, we have some others. And remember, these code sections are preservation sections, right? They don't eliminate the gain, they preserve the gain. So what other code sections the authors introduce you to?
1001.
Say again, Jesse?
1223.
1223, 1 and 2, right? 1223, 1 and 2. Jesse, what do those code sections say?
1223-1 permits the partners to
No, just paraphrase, yeah, I mean,
the
just
holding period.
holding period. And what is 1223.1? Talks about outside holding period, and what does it say? What is your holding period? Is it tacked or not tacked?
For 723-1 is tax.
Don't say dash, because I'm not talking about the regulations. The statute, 1223.1 is a statute, it's not a regulation, right? And is it always tacked, Eva?
Yes.
Always tacked.
Sometimes.
Sometimes. And Louis, when is it tacked, when is it?
Inventory is not taxed.
What is tacked? I think it's easier to say that.
1231 assets?
1231, right? 1231 and capital assets, right? And I know this is bothering some people last class. The 1245 recapture is treated as a separate asset, right? And it is not taxed, okay? You treat the recapture income as if it were a separate asset, and there's no taxing with respect to that. All right, so, and what does, Amber, what does 1223.2 say?
That the holding period of the property carries over to the partnership.
Okay, the holding period carries over into the partnership, right? Whatever your holding period was in the contributed asset carries over, and it doesn't matter the nature of the asset, right? All right? So we looked at these various code sections. You guys have to, I think, have a close working handle on 721, 722, 723, 1223.1, 1223.2. All right? And we'll see soon the contributed property, whatever the nature of the contributed property, is preserved vis-a-vis code section 724, which we'll look at some more too. So these things all go together. And again, 721 takes no prisoners. What do I mean by 721? Congress truly rolls out the red carpet treatment, right? That carpet is not a dull red color. It is bright red, right? It is bright red, so all the provisions that might otherwise give rise to taxability are thwarted. And the authors give us some examples. For example, you guys know Code Section 1245 can haunt people, right? Because recapture income can come up anytime. And 1245C essentially says, notwithstanding anything to the contrary, all recapture income shall be recognized. But we have Code Section 1245B, B3, that says, hey, when it comes to 721, and I'll add, I can't resist, 351 too, that these contributions to capital are not taxed, right? So And then the authors also, for example, when you have a disposition of an installment note, dispositions of installment notes are generally taxable. However, the regulations under 453-9C2 that the authors cite us to, not taxable. Okay, again, everything possible is being done because who wants to join as your partner? I know, Uncle Sam, right? Uncle Sam wants to join as your partner. All right, so you always have one extra partner. All right, and then I said to you, there's a revenue ruling or two that talks about forming a partnership, and I think it's pretty straightforward. You guys, if there's a problem or issue, you have to let me know. I called your attention, at least in the 10th edition, on page 38. There's a, I'll call it a fairly straightforward example of a partnership formation. This is the kind of questions you could see on an exam, or permutations of this, because in your practice, guys, I suspect that unless you're just filling out tax returns all day, you're going to be retained to help people form partnerships, and you're going to have to tell them what are the tax consequences with different property contributions, right? So everyone here should be able to handle page 38, right? And if you have a problem, you don't get it, you don't understand, you have to let me know. All right? Then, towards the end of class, I'm beginning on page 39, we had a discussion about partnership accounting, and it walks through, the authors walk through different capital contribution and how to report this for book and tax purposes, and it walks you through the asset, liabilities, and partners capital account. And I called your attention, beginning on page 43, that when there's a liability, I called your attention that 752 causes your outside basis to go up. Code section 752 causes your outside basis to go up, but there's no impact on your capital account. Capital account reflects your economic stake in the enterprise, and if there's a liability, particularly from a bank, it's not your interest in the assets have not gone up, the bank's interest in those assets have gone up. All right, so do bear that in mind, and you really have to look at these regulations. I told you that you are doing yourself the biggest disservice possible in this course if you think you can just read subchapter K without reading the accompanying regulations. They're long, they're tiresome, but they are worth their weight in gold. So be forewarned, you want to succeed in this course, you have to read the regulations. And I believe that towards the end of class, and correct me if I'm wrong, we finished, I think we did, page 45. Did we go through the actual example, or we didn't? No, we didn't? Okay, so we left off with page 45, correct? Yes, yes, yes?
Yes.
Okay. Before I go on, any logistical questions? Any, in terms of the course, or anything about the material up to page 45?
When I was trying to review it, I wasn't clear about the securities. When they sell the securities in the last part, I'm not sure how to do the accounting for that.
How they did the account. Let's go through this example on page 45, and I think, Amar, that's going to help clarify, I hope. And if you have a problem after that, shoot me an email and I'll try to walk through where, for clarification. All right? All right. Before I go on, any reports over the holiday weekend? Anyone do anything interesting that they couldn't wait for class to report back to us on? Big group.
We went to go the baby shower of my sister-in-law.
Baby shower.
Yes.
Boy or girl?
California.
You went to California?
Yes.
All right, so it's not around the corner. Wow. All right, congratulations. Anyone else do anything interesting? Go ahead, Andrew.
I was on the plane in the guy next to me loved partnerships. He was raving about how much fun they were.
I share his thoughts, but what was his, how did he, you know, when you
They're
talk
very
about
flexible
love,
and very good. Like, he had a lot of passion for it, and I was like, okay.
tax or just partnerships in general?
Partnerships. He saw my textbook, so reading while I was on the plane.
All right. That's what I like to hear. That's how you meet interesting people. You bring your partnership textbook, and the rest is history. I hear, you know, you don't even have to go on eHarmony or Match.com. Just carry this with you. It's your golden ticket to meet your spouse. All right. Anyone else? Nothing else to report? That's it? All right. Well, at least in my life, it was pretty quiet too this weekend. So hopefully we'll find something to contribute next week. All right, guys. So let's do on page 45. Let's see if you guys can make sure that you can handle this. We have ABC equal partners in this partnership. On formation of the partnership, A contributes $50,000 cash, B contributes land with a basis of 40, fair market value of 50, and C contributes securities with a basis and fair market value of 50. Everyone quickly sees A, B, and C are contributing properties of equal value. Everyone agree?
Yes.
No one's not seeing that. Agreed? And the only thing is, and I've always said this for tax, it's important to be empathetic and to put yourself in taxpayers' shoes. If you're a taxpayer, who's the happiest here? In other words, what I'm saying is, when you look at this, we're going to see there's special rules to protect against this, but if I'll just say, if B was contributing depreciable property worth 50 with a basis of 0, and you were taxpayer A and C, would you be happy if you were contributing $50,000 cash and taxpayer B was contributing property with a 0 basis worth 50? And the answer is probably not, and we'll get more into this as the semester unfolds. Why? Because normally you could depreciate that building, right, in the hands of the partnership. But if someone's contributing property with a lower basis, that opportunity is foregone. So just as you're going through this, put yourself in each taxpayer's shoes and just question, hey, would this be where you would like to be? Okay? So, with respect to this, we have, again, throughout the semester, guys, it's not a bad idea to always draw these balance sheets because they're going to be useful for you to see. So we have adjusted basis, book value, and we have cash, parcel 1, and we have securities, and we're told 50, 50, 40, 50, and 50, 50, right? Everyone agree?
Yes.
And we have 3 partners, A, B, and C. And they have adjusted basis and book value. And this is 721, this is the outside basis. So this is 722, right? This is 723. Everyone agree? 723 here, 722 here. And just want to make sure everyone sees this. This is outside basis. This is the inside basis. This is code section 722. This is code section 723. Agreed? That's our starting balance sheet. The partnership leases parcel 1 for $15,000. Rent, right? $15,000 rent, and sells the securities for $50,000, right? Last I checked, how much money is that going to bring in by the end of the year? 65, right? 50 plus 15. You can't invoke the after 8:30 rule, so you got to get it, nail it right. It is $65,000, right? So that means we're going to cash We no longer have securities, right? So we only have two assets. And we have cash will go up by 65 to 115. And this is going to stay the same. And we still have three partners now. On the securities, there was no gain. On the rent, what happens with respect to the rental income? They're equal partners. The income goes up by $5,000 apiece, right? Everyone agree? And by the way, I should circle, I will circle. These are their capital account. This is their capital accounts with respect to their assets. This is the capital accounts with respect to the partners. These are capital accounts. You got to maintain your capital accounts under 704. So A, B, and C, their capital accounts are going to go up by $5,000 each, right? Because they now have a right to $5,000 more apiece as to the assets on the other side of the balance sheet. And they're going to be taxed whether or not the assets or any cash is distributed. They're going to get a K1 at the end of the year showing that they're going to be taxed on $5,000, right, each. So their outside basis under Code Section 705 is going to go up by $5,000. Code Section 705, their outside basis is going to go up by 5. Everyone agree? So if there's a subsequent cash distribution, we'll see. Generally, the cash distribution subsequently will not be a taxable event. It will just cause their basis to go down, correspondingly down. We're good? Everyone can handle that, right? Simple.
But the sale of the security.
What happens with securities
The
then?
securities, there's no gain or loss under Code Section 1001, right? Their fair market value is 50, their basis was 50. When I say their, the partnership's basis and fair market value. So the securities just disappeared.
Okay, so just increasing cash.
Just increasing cash. Right now, let's do another balance sheet here. The partnership borrows $300,000 and buys more land. This time parcel 2, so it's going to use $300,000 plus $30,000 in cash, right? So what do you think is going to happen with respect to cash? It's going to go down, right? So we have cash, parcel 1, parcel 2. So cash is going to go down by how much? 30. So it's going to go from 115 down to 85, right? And parcel 1 is going to stay the same. Parcel 2, we bought it for 330. Guess what? Code Section 1012, that's our cost basis. Now we have liabilities A, B, and C. The liabilities are 300, right? What does that do to our outside tax basis? What do you think that does? Andrew, you're going to say? Does nothing. And Anthony, would you agree? let me ask you a question. If you, Andrew, went out there and bought property using borrowed money, would your basis in the property go up? What's your authority for that? I want to hear a case name. I want to hear a case name. Crane, right? Everyone agree? Under the Crane decision, your basis, right, takes into account the borrowed money, right? Well, partnerships for these purposes are treated as a conduit. Agreed? So what do you think happens to your outside basis as a result of borrowing this money? Increase. What's my authority? 752. Well, section 752 is critical here. We're going to get much more into detail. It is a complicated code section, but for our purposes for the moment, we're going to keep it really simple. Your basis goes up. Okay? So, with taxpayer A, Dixie, what's your taxpayer A's outside basis? And Ira, see if you agree. Dixie? Just say it loudly because we're a big room. Well, just give me a number. The number, Dixie, is outside basis. A's outside basis is what? Throw out a number. And Ira can agree or disagree. You have a number, Dixie? Ira? Ira, will you say a number? 50. Audrey? Amen.
Well, the start with 50 for each, and then we have the sale of the rent, 55 plus 100, it's 155 each.
155 each, Audrey, you agree?
155, 145. First one.
That's right. 155, 145, 155. Remember, B started off lower, right? B started off lower. And it's going to go up by 100, right? We're keeping it simple, but in our case, we're keeping it simple. This is not always going to be true. But we took out a liability of $300,000. We're going to take that 1/3, right? We have a 1/3, right? Amara, you got that? So our outside basis, it's as if, picture, if you could, everyone has their imagination, right? You're buying a 3-story building, A, B, and C. And guess what? Each one's buying 1 floor. And each one's borrowing $100,000, right? When do you say their basis each goes up by $100,000?
Yes.
Everyone agree? So if you can use your imagination, which you guys can, right here, you got that? Their basis is going to go up by 100,000, so it's going to be 155, 145, 155, right? Do they feel richer? No. So Lisa, does their capital account goes up? No. Everyone agree? Their capital account, as a result of borrowing this, ain't going to go up. Excuse my English there. Everyone agree? Their capital's because they don't have any bigger economic stake on the other side of the balance sheet. Agreed? Alicia, you got that?
Yes.
All right. I take a deep pause here. Everyone see this? You guys have to give me, outside of the class, 10 hours a week. How's that? Minimum. I won't stop you if you put 20 or 30, but a minimum of 10. Jackie, you got that?
The difference between why did you take the 30,000? The 115 minus 85 is 30.
I don't. Well, I'm not sure. What number are you
Why
put?
did you attribute the 30,000 to cash?
Because we used 30,000. We bought this building for 330, right?
Right.
Well, we have to get the extra 30 from somewhere.
And you only borrowed 300, so we used 30,000.
Yeah, we
Okay.
used 30,000 in cash. Other questions? Everyone's got this. All All right, if you don't, you gotta go back and keep going. Question C? Question C. All right? The partnership distributes $20,000 to A, B, and C. Now the partnership distributes $20,000 to A, B, and C. So Sal and then Karen, see if you agree. Sal, what should I do here to this graphic to portray this? What would you do?
Reduce their adjusted basis in cash.
So what would you do? Would you just reduce their basis by how much?
By their share of ownership.
Well, just give me a number. Well, Sal, you said that this is going to go down by 60, right? Because 3 times 20, right, is 60. So that's going to go down to 25. Everyone agree? Everyone agree? We're all good on that, right? Sal, help me out. Tell me more.
So you have to reduce their adjusted basis by 20 each.
Okay? Michael, you agree? Okay, but let's just talk about their outside basis first. Code section 733 says we have to reduce, right? Their outside basis by 20,000 apiece, right? 135, 125, 135, right? Everyone agree? This is 405, and this is 395, right? And this is 395. And Michael, you said, right, their capital account, right? Their stakes in the partnership went down, right? They got 20,000 out. Their capital accounts are going to go down, right? Everyone agree?
Yes.
Okay, I can't resist capital account maintenance. I'm just going to give you a citation. And these citations are long ones. All right? But the authors direct you to these citations, and you need to read these. So for the proposition that your capital account goes down by the amount distributed, that's regulation 704-1B2, 4 little i's, B4. Let me repeat, and these are long regulations, but you can find them. 704-1B2, 4 little i's, B4. Okay, you guys have to constantly read the regulations. Good news, the authors were very specific which regulations they need you to read. Last part of the question, question D. Suppose parcel 1 now is sold. Parcel 1 is sold. Okay? So now we're going to be left with cash and parcel 2. Okay, we're going to be left cash and parcel 2. We're going to get the visual. Now we're told that it's being sold for $65,000. We're told that it's okay. Now, if the securities are being sold, by the way, parcel 1 is being sold. You get 50,000. 65, excuse me. What is the book gain on parcel 1? If it's sold for 65, what is the book gain?
15.
Everybody agree? It's 15, right? It's being sold for 65, but we originally booked it for 50. There's a $15,000 gain on the books, right? But for tax purposes, Code Section 1001 applies, right? Code Section 1001 applies, right? And the amount realized is 65. What's the inside basis? 40, right? So for tax purposes, the gain is 25. Everyone agree? For tax purposes, the gain is 25. For book purposes, the gain is 15.
Most of my clients are tax basis, which is why I was confused as to why it's bothering me.
All right, but
I got it, yeah.
you got it? Now, what does that mean for our 3 taxpayers? Their capital account should go up by what? Maria? Maria, as a result, what should their capital account go up to?
I'm not sure.
Unsure? Megan?
I think the capital accounts go up by the 15.
Or 5,000 apiece, right?
Yeah.
Right, doesn't everyone feel $5,000 richer? And again, guys, put yourself, okay? I know some of us pretend to be superheroes. At least I do, I'll admit it, I'm sorry. It's part of our DNA, I think. But you can pretend to be A, B, or C. And in this particular instance, wouldn't you anticipate that, gee, while you were a partner, that parcel went up by 15,000, and I'm an equal partner. Damn it, I deserve 5,000 of that, right? Everyone agree? So if you can put yourself in those shoes, you will succeed. If you can put yourself into that mindset. So that means your capital account goes up to 40 each, right? Everyone agree?
Yes.
Liability still at 300,000. Now, who should be pegged with that $25,000 gain?
B.
B.
No.
You want to give it to the man, right?
Bifurcate.
Alicia, you said it loudly. Say.
I would bifurcate.
So what does that bifurcate mean in this
Means
context?
that 15,000 of gain will be split between 3 partners, and the 10,000 will be assigned to the one.
The contributing partner.
Yes.
All right, the first 10,000 is going to be assigned to taxpayer B. He brought that to the party, metaphorically, right? He brought the appreciated asset. He can't assign away that $10,000 to other partners. Cannot assign it away. He's got to bear the tax. So he bears the 10,000 tax on 10,000. Everyone see? Because when we originally started, he was the one who contributed this property with a $10,000 embedded gain. So he's going to be pegged with the first 10,000, and everyone else is going to have to be taxed on the other, each one on the 5,000. So he's going to be taxed on a total of 15,000. A and C are going to be taxed on $5,000 apiece. So that their outside basis will go up to 140. Right, 5,000 to A, 5,000 to C, 15,000 to B. And the cash, after the parcel sold for 65, is going to go up to 90. Parcel 2, 330, 330, that hasn't changed. 420, 420, 420, 420. So if this isn't the Mona Lisa, what is, right? All right, everyone see there's, and by the way, be forewarned, you're not always going to have this nice symmetry, okay? There will not always be the symmetry that you're seeing here, where things are in perfect balance. And don't think you drank too much that night if you're not symmetrical. You'll see, be forewarned, partnership tax, the way it's devised, does not always have the symmetry we all seek. All right, so the takeaway here, let's just review why the authors have these different permutations. So the first part of the question talks about, just question A talks about leasing, and there's $15,000 of income. Okay, got to divvy that up. Everyone has to pay their pro rata share, right? And your book account goes up by 5, your tax basis goes up by 5, right? Everyone gets paid for 5. Question B, the authors, what are they trying to illustrate? That borrowing does not increase, right, Lisa, your capital account. And what does that do, though, to your outside basis? Your outside basis goes up, right? What's the point in question C? That's just to illustrate, and we're going to get to this many, many weeks from now, but just to give you a little taste, that distributions, here's a shocker, reduce your outside basis and reduce your capital accounts. Okay, so that too has to be taken into account. And finally, question D is just to illustrate Code Section 704C, that if there's an embedded gain, or conversely, if there's an embedded loss, whoever brings that to the party bears the concomitant consequences with that. Lewis.
Where is B getting the 140 adjusted basis if he's getting the 10?
He's getting 10 plus 5.
Okay.
So he's getting the normal 5, but he's getting saddled with the first 10. So that's why he's going from 125 plus 15.
So if he gets the first 10 and then they split it between the rest. Okay.
Yep. Other questions? Go ahead.
So the 10 is being taxed by B.
Not being taxed by B. B is bearing the tax on the 10.
Paying the tax on it in the same, when it happens, when it comes to distribution. Or
When
when
it-
it's sold.
When it's sold.
When it's sold, yeah.
Not when there's a distribution, but when it's sold.
Okay.
He gets tagged with it. Adrian?
What if the book value gain was 10 instead of 25?
Excuse me?
What if the book value gain was 10 instead of 25?
It's 10 instead of...
That's all.
Then B would I'd like to know if there's book gain, the book gain is always going to be shared equally. And the tax gain, and this is where we're going to see disproportionality, the first 10 is always going to be picked up by B. So it may not be symmetrical, the outcome, Adrian. I know why you're asking your question, but that may not, and we'll see more of this, so be forewarned. All right, we're just getting a very quick glimpse of this. All right, so guys, now, what is the author's purpose? You see the operations in Code Section 721, 722, 723, 1223, 1, 1223, 2, 752, right? Basis adjustment for liabilities. And you're getting a glimpse of Code Section 733. What's 733? A reduction of basis for distributions. And you're also getting a glimpse of Code Section 705. What does 705 say? You have income, your basis goes up, and when I say basis, I'm referring to outside basis. If you have losses, your outside basis goes down. Okay? So you have to work on getting these code sections down. Eric? So say it loudly.
If they depreciated the land, would that only affect the inside basis?
If they depreciate, first of all, the partnership
depreciated.
let's not use the pronoun they. Let's use it depreciates the land. And if the partnership depreciates the land,
And they sell it, like, is the only inside basis that gets affected? Like, they're also attacking the 10,000.
look, your inside and outside bases will be affected because if you depreciate land, the inside basis is going to go down, and it's going to produce deductions, and those deductions are going to reduce your outside basis.
That's split equally between them.
I'm going to say for now equally, but you're going to see, depending on the nature of the contributed property, it may be disproportionate. All right? We're going to see interesting permutations. So again, guys, tonight you don't have to have mastery of this, but the authors are trying to give you a little bit of familiarity with various code sections at play. And as I told you last class, there's a whole chapter devoted to the issue of liabilities. And you might say, okay, that's fair. Let me get my feet a little bit more grounded before we get into this complicated issue of liabilities, because I want to feel strong before I do it. And then you say, gee, page 45, it's entitled Treatment of Liabilities. And you're like, I'm not ready for this. And are the authors here just to torment me, right? That may be your sentiment. They're, are they having fun just, throwing this in? And I said to you, the reason this is in chapter 2 and why they're trying to put it here and not simply 2 or 3 chapters from now is because people, when they contribute property to a partnership, often it is subject to liabilities. So the authors don't want to do you a disservice and skip over it and just pretend like, oh, it's always nice, neat, and clean. They want to introduce you up front to this concept of liabilities because that's the real world, okay? So despite what you may think that this is designed simply to torment you, it is not, all right? So let's get our feet wet. All right, now, look guys, any way you do it, I don't want to tell you how to do it, but I just sometimes, not always, I write little notes about each one of these regulations. Why did the authors have us read these regulations and not others? And again, the authors here are kind because the authors theoretically could have said, oh, read the regulations under 752. And you know what? The reality would be, even if you, and everyone here, I'm sure is a superstar student, most people wouldn't read all the regulations because they're about 60 pages single spaced, all right? Having said that, even the regulations the authors ask you to read are not short, but they're manageable. So, message, read them, all right? You really can't just read the statute and think you got this, all right? You don't, all right? So, the regulations the authors cite you to define what is a recourse liability and non-recourse liability. We spoke in general, and my only word of caution for you, for exam purposes, and when you deal with clients, but let's take the here and now instead of the client issue. For exam purposes, it would not be a bad idea if you circled the word recourse or the word non-recourse, because very different consequences are associated with those terms, right? Recourse versus non-recourse. And if you don't mentally make that distinction, that can be wholly problematic. Agreed? So you must. Now look, some of you are better readers than I am, but generally, even on this new edition, guys, generally, wherever it was relevant, I would circle the word recourse or non-recourse just to make sure I was getting it right, okay? So, word of caution, and anytime I'm dealing with clients, I like to hear them repeat. Are we dealing with recourse or non-recourse? Just for my mental sanity. And the regulations are very different because Regulation 752-2 deals with recourse, and Regulation 752-3 deals with non-recourse. Everyone hear me? So if we deal with -2, if you hear me say -2, that's recourse liabilities. -3 deals with non-recourse liabilities. And there's actually, when we get more into it, we're going to keep it simple tonight, try to. You may not think so, but we're going to try to keep it relatively simple. There's actually new proposed regulations on this, but for the moment, let's just stick with the here and now, the regulations that are in effect now and not with the proposed regulations. And essentially, if you recall, a recourse liability gives whomever lends the money recourse to go after the partners. Recourse means they can go after the partners. Non-recourse means, nope, they can't go after the partners, they can only go after the property, okay? There's non-recourse liabilities in which they can't go after the members of the partners, and recourse in which they can go after the partners. And this is spelled out on page 47, the second full paragraph. Talks about recourse liabilities, and the operative test, I have underlined in yellow, the second line there, in the second paragraph, is the economic risk of loss. That is the operative test. Who, if everything becomes worthless, who bears the economic risk of loss? And a few lines below that, and this details what does that mean, economic risk of loss. The determination is made by asking who would be obligated to pay the liability if all the partnership liabilities are payable in full and all the partnership assets, including cash, are worthless. So if there's something catastrophic, who ends up footing the bill? Okay, I'm paraphrasing, right? But isn't that the test? If all the assets, including cash, become worthless, you divvy up the recourse liabilities with the issue of who foots the bill. In contrast, the non-recourse liabilities, and again, this gets more interesting, non-recourse, generally, I'm reading at the top of page 48, generally are allocated among the partners in accordance with each partner's share of partnership profits, okay? So the notion is, when it comes to non-recourse liabilities, allocate them in accordance with the profits interest. And right below on page 48, they talk about the new proposed regulations, which we'll get into in chapter 6. Now, page 48, just to get our feet wet, the authors have a simple example, relatively simple example of these liabilities. And it says A, B, and C, A, B, C, and D, each contribute $25,000 to this four-person partnership, which then acquires $1 million building. It's going to pay $100,000 down, borrow $900,000 on a non-recourse basis. Everyone see that? Non-recourse basis. I have the word non-recourse circled. I want to remind myself to remind you. So is it the -2 or -3 regulations, guys? -3 is what I wanted to hear, right? -3, right, Lisa?
Sorry, I just want to ask a question. Are we going to talk about qualified non-recourse?
Are we going to talk about what?
Qualified non-recourse.
We're going to talk about qualified, non-qualified. We'll talk about it all, but not in detail tonight, Lisa. Okay? We just want general principles now. So we're talking about -3. So what is going to be, in this case, Luca? What's the outside basis going to be? James, see if you agree with Luca.
Outside basis is going to be.
You say it loudly, Luca, and then 25 each. James, agree or disagree? James, you're going to say? Not going to be 25. David?
Not sure.
250?
250?
Yeah.
Why? Where did we get that from?
900,000 divided by 4.
900 divided by 4 is how much? 225. And there's 25% profit interest, right? 25. So it's 25 or cash plus 225, right? Or outside basis of 250 each, right? And this would make sense, right? If each one bought one floor of a building, just to use my metaphor again, and each one put up 25 and borrowed 225, you would say their outside basis under Crane would be 250, right? No different. But here they're joining hands, 4 people, and hands held together. They form a partnership. Their outside basis is 250. Okay? Question B, what results if the partnership is a limited partnership? A is the sole general partner, and all the partners share profits and losses equally. So what results if the partnership is a limited partnership? A is the sole general partner, and they share profits and losses equally. Elena, would this change your outcome? Elena? Yes, no, maybe? And Jessica, see if you agree or disagree. So you got a 50-50 shot. Elena? Not sure. Jessica? Same? Alicia, you agree or disagree? You don't know yet? Someone else? Louise, you had your hand up? Oceana? You agree. The answer should be the same, right? Because it's non-recourse, it's still based on profits, right? So the outcome should be the same. Let's change it up. Question C. Now, what happens if the partnership were personally? What happens if the if the partnership were personally liable for the debt? And I think that's a way of saying if each of the partners was personally liable for the debt. Okay, Brianna, how does that change the outcome? Does it change the outcome? And with respect to question B.
Then I think that the partners couple, and then their outside basis could change depending on the debt.
Well, when you say that, can you give the numbers to it, Anthony and Jen, see if you agree?
Then what if their, if the partnership was liable for that, then their outside basis would be the same as condo tax, for 25 each.
So what would be their outside basis? I'm sorry.
25 each.
So they would, so you're saying what happens to the $900,000 liability? Jen, what happens to it? Javier, you were going to say? Anthony?
I think since the partners are personally liable, definitely is an impact. Does it change it?
Does not change it?
No, I think there is a change. It doesn't.
Okay, so tell me, how does it change it? Who bears the burden here? A. Right? If everything goes to waste, isn't A got to pay back the full 900, Amber?
Yeah, A is, since it's the general partner, it bears all of the risk of loss, and B, C, and D, they don't.
So A's basis goes up to 925, right?
Yeah, because it's the.
And what's my authority? 752-2-2A. Not dash 3A, because now we have recourse liability, right?
I have a question. Would that be in every case though, or would it be like, cause can't you change like the operating agreements to like sometimes not have that, or that would be always?
Well, you can change the operating agreement to share the liability, but most limited partners, keep in mind, are limited. They don't want exposure, so they probably wouldn't want to take on the liability, but if they agree to contractually to take on all or a portion, you can manipulate the outcome. But by their nature, limited partners don't want to, it's kryptonite. They don't want to touch the liability. Okay? All right, so the authors just want to give us a taste, but now they're going to go into more detail about contributions of encumbered property. All right, and the contributions of encumbered property, they're going to call to our attention the regulations under 752, of course. They're going to talk about 704C, right? 704C dealt with the earlier issue where B contributed property with an embedded gain, right? That if you have an embedded gain or loss, that ultimately if on the sale or disposition of that property, you have to bear the tax consequences with the embedded gain or embedded loss. right? So beginning on page 48, there's what the authors referred to as the general rules under 752. And then you're going to see, beginning on page 49, there's going to be 4 different general rules you have to consider. 4. Recourse liabilities in general, and then recourse liabilities in excess of basis. Okay, everyone notice. And I'll give you some foreshadowing. On the next page, we're going to talk about non-recourse liabilities in general, and then the following page, non-recourse liabilities in excess of basis. So everyone see that there's actually 4 different rules at play here. And they go through a common example where they have fair market value equal to 150. They have adjusted basis equal to 50. And they have a mortgage equal to 30. And they want to know the tax consequences if someone contributes this property. This begins the conversation on page 39, where A contributes this property. And if you look on page 49, if A contributes this property and is an equal partner with partner B, guess what? It's recourse liability. And you join forces, the other person, meaning taxpayer B, is going to pick up 1/2 of that liability. And when you have your liability reduced, what is that treated as tantamount to? It's treated as a cash distribution, right, Dill? Right, everyone agree? So A is treated as if A, right? If someone agrees to take over your liability, you're a happy camper, right? You feel richer, right? So if you have a $30,000 liability, I join forces with James, and James says, okay, Solid, I'm going to take over half your liability. That's a good day for me, right, James? And I feel $15,000 richer because now James is on the hook for the other $15,000, right? So James feels like he made a capital contribution. So James's basis is going to go up by 15, his outside basis, and mine is going to dip by 15,000. Everyone agree? Everyone see that? So for exam purposes, you want to figure out who's the one contributing, who's the one not. Make sure you identify the proper taxpayer. There's a lot of moving pieces going on here, right guys? So if you look on page 49, notice A's basis goes down by 15, outside basis and taxpayers B's goes up by 15,000. Jonathan.
It's a structural question. So, assuming you don't standard mortgage payments and installments, say B agrees to pay 1/2 of the mortgage each month going forward, is it assumed a $15,000 contribution then, or is it assumed piecemeal?
No. When you pay down the mortgage, I'm not sure what your question is.
Like if he's paying it in a series rather than a lump sum.
Well, it doesn't matter if it's series or lump sum. It's going to have the same effect. As we pay down, the partnership's going to bear tax, and as it pays it down, it's presumed it's going to pay it down. We'll be taxed on the money the partnership earns as it pays, and so our basis will go up. But as we pay down the liability, our basis will go correspondingly down. Just like it would be in Crane, okay? Just if you know the Crane decision, apply it here. But Jonathan, we'll see more examples. Again, the authors are just trying to keep giving us a taste. It's hard to be comprehensive at this point. So hold your questions on that, but just to give you a taste. So recourse liabilities, guys, again, the -2 regulations apply. Generally, for our purposes for now, it's in accordance with the profits interest. And the contributing partner, it's like a snake shedding something, right? I'm not an expert here. Snakes shed their skin, right? Everyone agree? Okay. Ask me a tax question. I'm not, reptile questions are beyond my pay grade. All right. Look, next question says, what happens if the liability, the basis instead of being 50 is going to be, I believe they said 10. Liability. And many of you who've had corporate tax, and again, you're not responsible for corporate tax, but I can't, resist throwing this in. What happens if you contribute property to a corporation where you contribute property where the liability is in excess of basis? Do you remember, for those who've had corporate tax? Liability. Remember, when you contribute property to a corporation, generally liabilities do what? There's no gain or loss. Go, Hero, you were going to say? I know your hand was up. They reduce your basis. Code section 3, they're ignored 357. Okay, but says you ignore them, except if you are doing it for ulterior reasons, or in the case of 357C, if the basis, the liability is in excess of basis, okay, you must recognize gain. In 358D, generally you reduce your corporate outside basis by the amount of the liability. So my point is, in the corporate sphere, anytime you have liabilities in excess of basis, your antenna should go up. I don't care if you're talking partnership tax or corporate tax. Everyone understand liabilities in excess of basis are problematic. In fact, even if you gift property, okay? This is a Supreme Court case on this. Suppose I gifted this property to a child of mine, right? What's the amount realized? Can never be less than the mortgage, right? And if my basis is 10, if I gifted this to my son, guess what? I have a part sale, part gift, right? Everyone remember? Part sale, part gift? So anytime, okay, this is a universal. Now in tax, how many universals are there? I'm just warning you. Anytime you hear of a liability in excess of basis, guys, brace yourself. Right, Tamara? Brace yourself. Anything can happen. It's like Hurricane Irma, right? Anything can happen. All right. So in this particular case, the authors give us a problem and say, what happens if the recourse liabilities, in this case, are in excess of basis? And it's one of the times where it can trigger a gain, right? Everyone agree? That if we're taxpayer A, we're shedding $15,000 of liability, our basis is 10, holy schmoly, contribution, and despite the bright red carpet treatment, just like it was in the corporate area, where we might under 357C have to recognize gain, in this context, damn it, we may have to recognize a gain. So just be careful, because you might send a quick email right before lunch or right before the weekend, because the client will say, oh, I want to form a partnership, and you're like anxious to get out of the office, and you just quickly type, don't worry, tax-free, have a good weekend. And they make this contribution, and it is not a good Monday for you. It is one of your worst ever. Okay, you don't have to see. Is this new movie called Mother supposed to be like a thriller? You know what I'm talking about? Isn't Jessica Lange who's starring in that? No, it's called. I think it's called Mother. Jennifer Lawrence. Thank you. Wasn't she married to what's his name?
Balls if I know. I have no idea.
Hold on. Isn't Jennifer Lawrence married to?
You mean Michelle Blank?
No. Who left her? Who?
She's not married.
Jennifer Lawrence
isn't married.
Oh, what, Amber? I'm asking you if Jennifer Lawrence is married.
No, she's not married.
Wasn't she married? Is
No.
It's
in the trailer. It's showing in the married. She's the married in the trailer, right? The mother one.
She's starring the movie Mother.
Yeah.
But you're telling me, I'm just asking you in real life if she's married.
No.
Who was married to the guy? Who started, there was a movie, going on 17 or,
13 going on 30?
yeah. Ben Affleck, and what was his wife's name?
Jennifer Garner.
Oh, sorry, got my bad. All right. Anyway, I'm not quite sure how I got there to there. Oh, I know. All right. My point is be careful, because here, the nightmare scenario is you're saying to people non-recognition and you have recognition, right? And it's not the place you want to be. Email.
So in this case, for A, you will have 0 basis.
Zero.
And 5,000 gain.
Yep. Okay? Everyone agree? And B's outside basis will go up. So for exam purposes, don't just say, well, I always know at least with 721 I can get something right because there's never going to be a gain, so I'll get some points. Just always answering no gain. No, that's not true. All right, and be forewarned, be careful, whether it be in the corporate area or the partnership area, sending those quick emails. Those are disastrous. All right, non-recourse liability. So I told you there's 4 quadrants. Recourse generally, recourse with liabilities in excess of basis, and then now we have non-recourse in general, and the authors on page 51 talk about the fact that, again, for the time being, we're going to assume that it's in accordance with profits interest, and that means in this case you're going to split the liability equally, right? So there's some shedding going on. And the other basis, person basis is going to go up. And then we have non-recourse liabilities in excess of basis. Non-recourse liabilities. And here, we're introduced to the concept, this takes some doing. I'm going to call your attention on page 52. The first full paragraph, which is entitled Non-Recourse Liabilities in Excess of Basis, about 10 or 11 lines down. On the left-hand side, it has 704C1A, like 10 or 11 lines down. But if you look to the far right, their sentence begins, in keeping with the principle that non-recourse debt is allocated in accordance with the partner shares of partnership profits, the Section 752 regulations provide that a partner who contributes property encumbered by a non-recourse debt is first allocated that portion of the liability equaling the gain that would be allocated to that partner under Section 704C if the property was sold at the time the contribution for an amount equal to the liability. So let's pause there. That's Regulation 752-3A2. Okay, that's the citation to footnote 73. So the point I'm raising here is that when it comes to non-recourse liabilities in excess of basis, right? The mortgage is 30, the adjusted basis is 10, the amount in excess is 20, right? Everyone can handle that. That is the minimum gain, right? If this property, the person just walked away under the Tufts decision. Remember Crane? There was the Crane decision, then there was the Tufts decision. If you just walk away from property and the liability is in excess of basis, right? Isn't there a minimum gain here of $20,000? Everyone agree? Who has to pick up that gain? The contributing partner, A, right? So no matter what, A has to pick up that. So the first $20,000 of this liability is allocated to whom? A, the contributing partner. How about the remaining 10? Well, that gets split 50-50. Right? That gets split 50-50.
Can you say that again?
All right? So the minimum gain here is $20,000. That's the amount the liability exceeds the adjusted basis.
Got that.
Okay? That leaves $10,000 of the liability unaccounted for. And then we have to split that in accordance with the partner's profits interest.
Okay.
So it gets split 5 and 5. Okay? Go ahead, Ashley.
And does the gain for the non-recourse debt affect the basis?
I'm not sure what you mean by the gain. This is, what the point I would make is that the basis here to A is only shedding 5,000 of the liability. So A's basis goes down by 5,000. Taxpayers B's basis go up by 5,000. Okay? Jane, can you just shut the door up there? I think the door is open. Maybe I'm wrong. It's a little loud up there. All right. So let's look at page 53. We have A and B each contribute $30,000 cash. ABC partnership, C contributes land held for more than 1 year. Worth $60,000 and subject to a recourse, I have the word recourse highlighted, debt of $30,000. A, B, and C are all general partners with a 1/3 interest in the profits and profits and losses of A, B, and C. Okay? So we have a fair market value of 60, mortgage of 30. And the other partners, does this make economic sense that they would each be 1/3 partners, guys? Would you join as a 1/3 partner here if you were A and B? The answer is yes, right? Because C is contributing property, right? Net of the mortgage worth 30, right? Everyone agree? Economically, this deal makes sense. That's important. And it's recourse debt. Okay? So we're asked the question, what are the tax consequences if the land has a basis to C of 40,000 and the partnership assumes the debt? The adjusted basis here is 40. So just to let you know, just to change it up a bit here, the fair market value is 60. And just keep the colors right straight here. The adjusted basis we said is 40. The mortgage is 30. So the liability is not in excess of basis. Everyone agree? We'll get to that. And we want to know, we're going to do various balance sheets here. Okay, we have cash, we have land, we have adjusted basis, we have book value, we have adjusted basis, and book value. We have the liabilities, we have A, B, and C. This part is easy, right? 60,000 in cash each. And the land, the inside basis is 40, value of 60. And the book value, we know the liability is 30, but we each know that their capital accounts are all equal at 30. My question is, what is their outside tax basis? Eric?
40, 20, 40.
Luke, see if you agree.
Yes, 40, 20.
All right.
Pretty sure it's safe. Yeah.
So what's your answer?
40, 20. Sorry.
40, 40, 20. Now explain your rationale.
Sorry. Oh, it's recourse debt, so A and B are taking on 10,000 additional each.
Okay, so everyone agree it's recourse debt. Each one is assumed the liability, so their outside basis under 752 goes up by 10,000 each, right? And taxpayer C, why is the basis 20? Shedding 20,000 in liability, that's considered tantamount to a cash distribution, right? So the liability goes, their outside basis goes down by 20 by authority code section 733. So everyone have this? This is recourse. This is under the regulations under 752-2A. Everyone have this? All right, next question. Question B. Same as A, except the land has a basis to C of 10,000. So now we're going to change this, right? Look familiar? So what are the consequences here, Kelly, to the taxpayers?
The outside basis ends up being 40,040, and then there's a $10,000 gain.
Okay, so let's start. Taxpayer C is considered as if taxpayer C had received a $20,000 distribution, right? Because taxpayer C is shedding 20 of the 30. Everyone agree? Notice the shedding process. That's considered a $20,000 distribution. Outside basis here is only 10. So C's outside basis is going to go down to 0. Right? Everyone agree? And C is going to have to recognize a $10,000 gain. Okay? Keep going. So here, this is $10,000 basis, right? Attributed property has a $10,000 basis, and taxpayers A and B, their basis is going to go up, right? Because they're going to consider it as if they made an additional $10,000 capital contribution. And this is 70, this is 120. I want you to notice this. Notice the asymmetry here. It is not going to always be symmetrical. And we'll see more as the semester unfolds why that is the case. But notice that it is not, you can't always check your answer to say, gee, is my inside basis and my outside basis symmetrical? You will not always achieve that result. All right? So the answer here, let's summarize, is that taxpayer A and B, their outside basis is each going to go up by 10,000. C is going to be deemed to have shed $20,000. So C is going to recognize $10,000. Now, the question D asks, what could C do to avoid this result? Right? Everyone see that? What could C do to have avoided this result? If you're helping this taxpayer, taxpayer C is your client. Ashley.
Sell the property.
I'm not sure what you mean, sell the property.
Sorry, sell the land. So
And-
C should sell the land and contribute the cash of $30,000. So they get $60,000.
All right, but
to pay off their mortgage.
Ashley, let me just make the observation. That's almost too convenient. What do I mean by that? let's say this partnership, remember, land is not fungible. So let's presume the partnership really wants the land. Could C not just contribute another $10,000 of cash? Would that have raised C's outside basis? And therefore, just by contributing the cash, would not have had to recognize the gain. Agreed?
So contribute the land and the 10,000 cash. Those are separate.
Contributes both the land and cash, right? They have to figure out economically, does that, will the other partners contribute? You know, how are they going to do this? But I'm just saying, one easy solution, actually, if they really want the land, is have C contribute cash as well. That's one alternative. Another item the regulations mentioned is that, and someone else mentioned it, I forget whom, that partnerships are flexible. So in their partnership agreement, they may agree, A, B, and C, that only C will be liable on this debt, that C will be entirely liable, and A and B will not. So therefore, if they're going to make C entirely liable and A and B not, then there's no shedding of the liability. Okay? There's no shedding of the liability, and Regulation 752-1G, Example 1, permit that. Okay? So if C agrees to remain on the hook, we should be okay. We should be okay. 752-1G, Example 1. And I'm just going to call this to your attention. You notice the asymmetry here. We are going to learn in the weeks to come, you can make what's called a 754 election. Okay, I know Jenny's shaking her head. Yes, Jenny, we can make a 754 election. And by making a 754 election, we will get symmetry here. Okay, there could be, just for your notes, I'm just pointing out to you that if there were a 754 election here, 754 would permit the inside basis $10,000 adjustment. But that's a discussion for a different day. I'm just giving you a heads up that that would permit an adjustment. Let's go through questions C and D, and then we'll take a break, guys.
So, sorry, for B, for C. So he's gonna have 0 basis and 10,000 gain.
Yes, it's not a good day for taxpayer C. Okay? Question C. Okay, let's do 2 more questions, then we'll take a break. Same as A above, except the debt is non-recourse. Okay, now we're going to uncharted territory, we're going to non-recourse. And the partners agree that for purposes of allocating the non-recourse liabilities, they each have a 1/3 interest. So the question here, we're going back to the original fact pattern. Back to the original fact pattern. Would the answer be the same as in A? Would the answer be the same as in A? For question C. Would C, taxpayer C, be shedding 20,000 of liabilities?
Yes.
Yes. Would the other 2 partners be picking up 10,000 of liability?
Yes.
Yes. So the answer is the same. In this particular instance, the answer is the same.
That's because we allocate the liabilities the exact same way, right?
We're going to allocate, in this particular instance, the liability in the same way. But that doesn't exactly happen with respect to question D. Question D says the same as B above, except that it's non-recourse. So now we're back to this fact pattern, except that it's non-recourse. Okay, so think to yourself, what, if any, is the minimum gain? Of that 30,000 liability, what's the minimum gain that taxpayer C would experience here? 20. Everyone agree? So the 20 remains, the 20,000 remains with taxpayer C. Everyone agree?
What does that mean?
It means that C has to endure the first 20,000 of gain.
Okay.
So that 20,000 of the $30,000 liability stays attached to taxpayer C.
Does he recognize it right then?
No, he doesn't.
Oh, okay. That makes more sense.
Okay? Everyone agree? The first $20,000 of the liability, C is going to have to endure. What about the remaining $10,000 of the liability? How's that going to be divvied up? The remaining 10. Say again, Alicia?
I would say equally.
Equally, which means what though? It means that our taxpayer C is shedding $6,667, right? 2/3 of that, right? Of the 10,000, and keeping 1/3, or $3,333. So their basis goes from 30,000 up to 33,333, 33,333, and C's basis is 3,333. This equals 70,000, and everything else here is the same.
Wouldn't C's go down?
I'm sorry?
I thought C's go down.
It does. It goes down from 10,000, right? That was the original basis.
Oh, sorry, maybe I can't see the numbers.
Right? Wasn't his original outside basis under Code Section 722 10,000? But C is now going from 10,000 minus $6,667, right?
And plus 20,000 gain.
Not plus $20,000 gain, right? Because Dill will tell you, the 20,000 is not recognized up front. It is not. It's just that he's not shedding the $20,000 of liability. The first 20 of that 30,000 liability.
He's still on the liability.
Yeah, because if that property is disposed, the first 20,000, he's got to pick up an income, right?
Oh, okay.
704C. That's the minimum gain on the property. E-man, if they just, if he walked, taxpayer C just walked away from this property, who picks up the first gain? I'll answer that. Taxpayer C picks up the first 20,000. What's my authority? The Tufts decision. Right? Because the amount realized is 30, adjusted basis is deemed to be 10. The first 20, taxpayer C is deemed to have to pick up. That's the minimum gain. The C just walked away. Absorb that. Now, guys, we're going to take a break, but be forewarned, we don't have the luxury of time here. So, try to keep it to about 8-9 minutes maximum, and we'll get started around 10 of 8, okay? So, good news, the cafeteria is now open downstairs, so grab something to eat. Grab some coffee. All right, everyone ready? All right, here we go. So, this is not for the faint of heart. This is not something you can do, as I said time and time again. No wine glass in one hand while you're doing this. You know, you can try, what do they call it? Nitro, the iced coffee from Whole Foods. That will keep you going, okay? It's some powerful stuff. All right, so liabilities, you're getting a taste. Recourse versus non-recourse, and secondarily is the liability in excess of basis. Okay? Liability in excess of basis. All right.
Are we skipping number 2?
We're not skipping number 2 because it would be, you know, you wouldn't skip over a good portion, you know, one portion of the meal, right? So we can't do that here. Question 2 says, attorney, cash method, unincorporated sole practitioner, who has a cash method partnership of 3 other attorneys, all of whom are equal 1/4 interest in the partnership. after attorney joins the firm. Attorney transfers some accounts receivable for services with a zero basis and $20,000 face amount to the partnership as part of her contribution in exchange for partnership interest. So everyone notice, we're forming a partnership and someone's transferring accounts receivable, okay? In return for partnership interest. The partnership also assumes $6,000 of the attorney's accounts payable. What are the tax consequences to the attorney? In other words, if you contribute accounts receivable, what's your basis in the accounts receivable? A big goose egg, right? Zero. Agree? Everyone agree? It's a zero. And the partnership's assuming your accounts payable. Holy cow. Assuming your liability, and you have a zero basis. On the face of it, everyone should be nervous, right? Why should you be nervous? Because you know, right, Tamara, liabilities in excess of basis brings sweat to your brow. However, just like in the corporate tax area, section 357C3 says if it's a deductible liability, then it's not considered a liability. And are you going to be surprised to learn if it's an account payable that's a deductible liability, and an account payable is a deductible liability, is not treated as a liability for partnership tax purposes. So therefore, fear not, sleep easy, there is no recognition event here. Okay, I repeat, here the contributing partner is contributing property, accounts receivable, with a zero basis, and notwithstanding the contribution of an account payable, no concern here. Okay?
Does her capital account go down for that amount? Does that have a part?
Does her, let me just think about that. Dill raised the question, does her capital account go down? I'm thinking out loud, I don't think so. It depends on how the other partners look at it. I don't know if they're going to look at it as, hey, we got to put up with this, so your economic stake is smaller. You got to think about that, Dill.
Because if we tried to set one of these up, I'm just trying to figure out where it would go. You have a liability, you have
A $6,000 payable. I think I'm trying to put myself in the shoes of the other contributing partner. I might say you got to reduce your, hey, we're picking up this tab. I want you to reduce your capital account accordingly because, hey, you got a smaller stake in the enterprise because we're picking up your liability. So chances are we probably pick that up in the capital account, vis-a-vis a reduction in it. Capital accounts are really pivotal, right? Because capital accounts, you know, I always say to my clients, pay attention to your capital accounts. They're not something just to say, well, we can ignore. Something happens to the partnership, they represent your liquidation interest in the enterprise. So consider them carefully. Your purposes for your notes, what the authors are trying to do vis-a-vis the second question is just to point out that a deductible liability is not handled under Code Section 752. Okay? It is not handled under Code Section
For the
7.
other owner, the 6,000 would not affect them.
It would not affect your outside basis, you know. Would not, because it's something that's payable, and when it's paid, it will cause a reduction of their outside basis, right? Because the payment, something that's deductible, right? Under 705, anything that causes a payment reducing taxable income reduces the outside basis.
So if he give him notes payable, it's the same thing?
I'm not sure what you mean if he gives
If
a note.
I have a note that I liability, and I give it to the owner to observe.
Be careful, a note payable is not a deduction. It's not something which is deductible. That's a real liability. An account payable is a deductible liability. It's not considered a real liability. Because it's deductible. An account payable is a pure liability that the partnership absorbs. That's truly a liability. Hold that question. Let's just keep going. All right. Organization and syndication expenses. Guys, many of you, if not all of you, have had income tax before. Some of you, not all of you, have had corporate tax before. And the good news about tax is that the more you know, the easier this stuff becomes, or at least that's my aspiration. And including here is the fact that, hey, if you've had income tax, Code Section 195, if you recall, discusses startup expenses. And startup expenses, right, the first $5,000 is deductible. Anything above that has to be amortized over how long? 15 years or 180 months, right? And to the extent you have startup expenses in excess of $50,000, you lose your ability to take that $5,000 expense immediately, right? So if you have $54,000 worth of startup expenses, you can only deduct $1,000 immediately, right? Because you exceeded 50 by 4. And the other 50, let me do my arithmetic. The other 53,000 now, you would have to then amortize over 15 years. Okay? So, Code Section 248 is in the corporate tax realm, and guess what? It parallels Code Section 195 to a T. It permits $5,000 of deduction, the other over 15 years, and we have the same dynamic where if you exceed 50,000, you lose dollar for dollar the $5,000 upfront deduction, and no one's going to fall off their chair if I say, what happens with respect to Code Section 709? Voila, same thing. $5,000 worth of immediate expense. Anything above that, over 15 years. To the extent you exceed 50,000, dollar for dollar loss of that immediate deduction, right? Same rules. And syndication expenses, not deductible. Okay, everyone hear me? Syndication expenses not deductible. And the regulations are very similar to what they were in Code Section 248. And the authors try to give you an idea what are syndication expenses, okay? We don't need to spend a long time with this. This is pretty self-explanatory, okay? So, let's talk about this problem, and then I want to conclude with a message or two towards the end on page 55. So, we have a problem, Napa Hotel. It's a limited partnership that was organized in December of the current year to construct and operate a luxury hotel. By the way, for the first time in my life, this summer, I got to the Napa Valley. Having said that, my daughter was taking a course at Berkeley, so I got out there. Now, how many of you have been to Napa? See, you're talking to someone who's not a wine drinker. So, I don't know, are you wine drinkers? Wine drinker? So to me, if you're not a wine drinker, I'm not quite sure what the whole thing's about. It was pretty, but it wasn't like, oh my God, kind of pretty. I don't know, that's my 2 cents. So if you ever go to Napa, keep your expectations, unless you're a big wine drinker. I'm not sure. Anyway, just my 2 cents. Developer will serve as a general partner, contribute $100 cash for his interest. Limited partnership interest of $100,000 each have been sold by broker to 20 investors, okay? So someone's putting up a little bit of money, and you're gonna, they're soliciting big money from outsiders of $100,000 apiece, who was sold by broker to 20 investors, so there's a lot of money at stake there. Each of them has been furnished with voluminous prospectus describing the offering. All the investors are clients of financial planner with an affiliated broker who acts as an investment advisor to wealthy individuals. Okay? To what extent are the following expenses, all of which are to be paid out of the current year, are the $2 million contributed by the limited partners who are classified as organizational expenses and as such qualify under Code Section 709, potentially as deductible? and which ones are not? How about a $100,000 placement fee paid to broker for his efforts in selling the limited partnership interest? Well, is that considered an organizational expense or a syndication expense? Syndication. Everyone agree? That's a syndication expense. As such, it's not deductible 709-2B. Regulation 709-2B, not deductible. How about $50,000 organizational fee paid to developer for his services in connection with the organization of the partnership, negotiating the forms or the terms of the partnership agreement. So here we're paying an organizational fee. Hint, hint. I think that sort of gives away the cards here. Could be an organizational expense, okay, guys? That should qualify as an organizational expense. So this is under 709-2A. Question A was under 709-2B. This is under 709-2A. Should be a deductible organizational expense. Question C. $40,000 paid to attorney for drafting the partnership agreement, filing the necessary papers, and preparing the offering documents. Okay? Everyone see that the attorney here is being paid for multiple duties, right? So, what would we ask for this attorney? We would like to get a breakdown of his or her time. Why? Because some of these expenses, like drafting the partnership agreement, should be an organizational expense, right? Deductible. Conversely, preparing the offering documents, that sounds like a syndication fee, right? And as such, non-deductible. So we would need to know more about the nature of these expenses, but we would need a breakdown of the attorney's time so that some of these expenses would be non-deductible, some would be deductible. How about $10,000 to accountant for preparing the financial projections included in the offering documents? Syndication or organizational? Yeah, it looks like a syndication, right? Non-deductible syndication. How about $10,000 paid to printer for printing the limited partnership offering prospectus? Non-deductible, right? Cameron, I think I heard you say that. Not deductible syndication. How about question F? $20,000 paid to tax attorney for tax advice to the prospective investors for preparation of a tax opinion letter concerning issues affecting the partnership. Okay, tax opinion letter concerning issues affecting a partnership. Okay. And probably, this one's not entirely clear, but since it's more in the nature of a syndication expense. Why? Because it's trying to lure prospective investors. So probably non-deductible syndication expense. How about G? $40,000 is an initial fee to financial planner for services to be rendered by her for reviewing partnership tax returns, assisting in the preparation of financial information to be furnished to the limited partners, and acting as a liaison between the general partner and the limited partners.
Sounds like operating expense.
Yeah, this may be an operating expense. This may not even be, this is an ongoing expense. And last I checked, this may qualify, as Dill is alluding to, I think, as a 162. Operating expense, right? Go ahead.
It's a prepayment though.
Okay, so Benny, how does that color your answer?
Well, I don't know that it should be deducted every year unless something is right.
I agree. You have code section 461 that deals with prepaid expenses that But let's just, without getting into the issue of timing, okay? Is it deductible or not?
It is.
It has an aroma of being deductible as an ongoing expense. So, Benny, you raised a good issue, but that's an issue for a different day. All right? Now, before we conclude this chapter, for some of you who have an earlier edition of the book, okay, let me just call to your attention something that's worthwhile now, and we'll revisit it. The authors have moved this to a different segment, but I think it's important to consider. Let's take the corporate area. Again, you're not responsible for this in the corporate area, but then let's apply it in the partnership area. If you contribute services to a corporation and get back stock in return, taxable or not? Taxable. Why? Because let's just make this observation. Code section 351 generally says tax-free, but 351D says the contribution of services does not constitute contribution of property, right? So therefore, if you contribute services and get back stock, I remember you guys may have your own stories, but there's a story of, I read this, I don't know if it's fake news or real, I think it's real in this case. People who painted Facebook at the time Facebook couldn't pay its painters to paint the interior of its corporate offices, and the painter said, okay, reluctantly, we'll take stock. Need I say more that the stock that they got, they've never been paid so healthfully, and I think that like paint the inside normally would be $100,000, and the stock turned out to be worth several millions of dollars. Okay, but they had to take into income the fair market value of the stock they received. Right, it's not considered 351. And similarly, if you perform services for a partnership and you get back a partnership interest in return for your services, how are you going to be taxed? Whatever the fair market value of your equity interest in the partnership. And because remember, 721 protects the contribution of property to a partnership. It does not protect the contribution of services. Agreed? Everyone see that distinction? It's an important one. Now, suppose you join a partnership, and instead of saying you join a partnership, you contribute services, and they make you a 1/4 partner in a partnership, and there's a building. The partnership owns a building worth $1 million. Anyone going to be surprised if I said, in general, that you should be taxed on $250,000? Everyone agree? We can debate the fair market value, but you contribute services and you have become a 1/4 interest in a partnership with a building, so be it. Conversely, suppose you perform services for a partnership, and instead of being given what's called an equity interest, you're given what's called a profits interest. Everyone hear me? Hear the word, the adjective profits? Not equity interest, profits interest. And for years, and we're going to get into this in the weeks to come, how should you be taxed if you receive a profits interest in a partnership? And what I mean by a profits interest is that going forward, I join with these three folks, and we're going to now be a partnership, the four of us. And going forward, for every $1,000 that's earned, we each get 25%. The question is, should I be taxed on my receipt of my 25% profits interest? And your answer is generally?
Yes.
No. And the answer is why? It's speculative, right? I mean, my 25% profits interest may or may not be profitable.
When you earn, when it's earned, you'll pay tax.
I will pay tax when it's earned. I feel richer because now I'm joining forces with these able-bodied people, but it's merely a profits interest, right? It's akin to, maybe I won't get a bonus later this year. It looks promising. Every year I get a bonus, but I may not. So I just point your attention this bifurcation of two different worlds. That if you see on an exam a question where you get an equity interest, taxable. You get a profits interest, generally not. Kelly?
So it wouldn't be taxable even if you receive nothing else for your services?
It would be not taxable even if I received nothing else. Even if I was the most Pollyannish person walking the planet and I said, I'm doing a lot of services, wishful thinking. Notice the difference between that and Facebook. In Facebook, I was actually given an actual interest in the enterprise owned property. In this case, we don't own anything, or I'm just given a mere profits interest. Jonathan?
So in that case, if you receive the profits interest, you get to share in the losses as well, and that you can write that.
We would arrange it. I mean, maybe I will, maybe I won't. Well, that's going to be in the partnership agreement. I am saying this. Those profits, I want 25%. I put in a lot of services, Jonathan. So I want that. All right?
And you get taxed when you get the actual 20?
I will be taxed when and if there's profits on my, whatever we negotiate. All right?
Question. Now, if you receive equity payment for services rendered, and you're fully taxed in the year, right? Now, what is your basis in partnership?
Whatever the fair market value is.
Fair market value. That's
So if the building was worth $1 million and my 1/4 interest, my outside basis becomes $250,000. Right? Just like if you pay me with a plasma TV for my services, whatever the value of the plasma TV is,
At the date of service?
at the date I receive it.
So you're considered to have that cash then, if they're taxing you on all of that income.
Say again?
So you're also supposed to be a cash contribution then?
Yeah, it's akin to, I got the cash, I use my cash to make the purchase, and I contribute that property. Right? So the authors are gonna bring that up to our attention. They changed for those who have the 9th edition. They raised that later. I'm not so sure I would have moved it. That's their choice, but I think it's important up front that you know about the contribution of services, okay? Contribution of services can go one of two different directions. And it can be taxable or it may not be. Chapter 3. Is entitled Operations for Partnership General Rules. Okay, and again, the theme of entity versus conduit comes through, and the authors introduce us to 3 new code sections. They're not that new, but let's just call them to your attention. If you want to just open up to code section 701. Code section 701 says partners, not partnership, subject to tax. Okay. Standing for the proposition is conduit entity. 702 talks about how when you get a K1, essentially, I'm going to translate this, certain things have to be individually stated. You get a K1, some things have to be individually stated. And code section 703 talks about the income of a partnership shall be computed in the same manner as an individual. And it talks about similarities and differences. We're going to go through this, but I'm just calling to your attention. Bear in mind that for many, many years, when were corporate tax returns due? March 15th. When are they due now? April 15th. Everyone agree? Corporate tax returns historically were due the 15th day of the third month after the close of the tax year, whether it be a calendar year or fiscal year, right? And partnership tax returns used to be due. Used to be due April 5th, the 15th day of the fourth month. Now, Congress changed it around on us, right? And now, under Code Section 6072, partnership tax returns are due when? March 15th, right? Generally. Okay, we're going to talk about the partnership tax years shortly, but generally, partnership tax returns are due the 15th day of the third month after the close. Okay? So, the authors want to introduce us to this concept that we got to respect the partnership as a separate legal entity, as a separate taxpayer. So it tries to illustrate that proposition as the partnership is a separate legal entity with Revenue Ruling 68-79. In this case, we have a relatively new partner buying an interest in a partnership, but the partnership itself holding a capital asset for many months. And during the tax years in question, to get a long-term capital gain under Code Section 1222, the holding period was not more than 1 year. At the time, it was just merely more than 6 months. Everyone agree? That the holding period was much shorter for this during the time period this revenue ruling was rendered. And if you buy, you, meaning anyone in this room, buys a partnership interest, and the partnership has been holding a capital interest, or capital asset, I should say, for more than 1 year, and sells the capital asset, can you achieve long-term gain treatment even though you may have just bought your partnership interest 2 weeks ago? And the answer, as reflected in this revenue ruling, is yes. Okay? The partnership is treated as a separate tax-paying entity, and it dictates the character, the income of the assets it holds. Okay? So everyone notice, it, not the individual partner, controls the character of the income. Help me out here. I don't know the origin of this name. Page 59. What is that case, the pronunciation? Anyone want to help me who says, oh, what ethnicity is this? Go ahead, Jen. Say it loudly. Diversion? Say, how many syllables, Jen? Okay. Can you say it loudly, Jen? Because you are whispering, at least from my vantage point.
Diversion.
Diversion?
Yeah, I know someone with that last name.
What's the, is it Albanian? I am just...
Lebanese, I think.
Lebanese?
Yeah.
Really? Okay. Anyway, Jen, do you recall what this case was about? You got yourself in trouble. What happens here?
They each 50% of stocks, and the building was condemned.
Where was the building owned?
Newark.
Good old Newark! All right? I didn't do a search. I was trying to figure out. Who knows? Maybe it's on Washington Street. I mean, who knows? Right? But somewhere lurking nearby, this partnership building was owned, right? And what happens to it? Say again? It was condemned, right? And there is a code section. Many of you are familiar with 1031 rollovers, right? But there's a code section that 1033, that if property is condemned and you can get replacement property, as opposed to code section 1001 applying. Code section 1033 allows for tax-free rollover. Agreed? Okay, so picture, if you will, the partnership owned the property that was condemned. The property is condemned. The partners, in one case, found replacement property. I believe the other case they didn't. But they wanted to put the property in their individual names. Does that work, Jen? No, if a partnership, you gotta respect that partnership in the morning, right, guys? And that being the case, if the taxpayer here, the partnership, has property which is condemned and you want to avail yourself of this rule, the partnership, not the individual partners, have to find the replacement property, right? If not, you're going to thwart the ability for a tax-free rollover. So, one more illustration. This is not one of those cases you can name drop it up. Well, for my case, I can't even name drop it because I can't pronounce it. But putting that issue aside, you know, I can handle Crane. But putting that issue aside, this is not a go-to case name dropper, all right? Because, you know, the authors are just trying to illustrate simple proposition here, just like they did with the revenue rule. All right? Taxpayers bring up all sorts of arguments. If you don't mind me saying, silly arguments. If you've got to argue after filing partnership tax returns, all of a sudden that this office complex was held as tenants in common, you know you've got a losing argument, right? Whoever took this case, I hope they didn't take it under contingency because this had all the aroma of being a loser, right? This was not the case I thought, gee, taxpayers even came close, had a glimmer of hope here, all right? All right. Taxpayer loses, not a big deal, okay? Not surprising, right? Then we have this Schneer case, right? Page 62. In my humble opinion, should this case, which occupies quite a few pages, if I and my druthers, I'm not so sure if I were the authors of this textbook, I would have graced the pages with this. I think I would have heavily edited it.
Yeah, it was so repetitive. I was like, they keep going with the same.
I know, right? Ashley got frustrated, right? All right, I go for it. I hear you. All right, and again, not a name dropper. Okay, not a name drop case. The case itself, remember, is there a red carpet treatment when it comes to partnership formations? And we say generally yes. Once in a while, you may be staring income in the face, right? If liabilities or nexus of basis and other issues provide. But generally, there's bright red treatment, right? That 721 says not taxable because the government, just like in the corporate sphere, wants to promote business formation. So when it comes to, if you recall, our famous Lucas v. Earl case, there's a name dropper, right? And the fruit and the tree, right? And the language that you can't assign the fruit to a different tree than upon which it grew. You know, these are things you carry with you throughout life. I see, is this still, you're eating an apple, it's just because you knew we were going to be talking about Lucas v. Earl. I appreciate you bringing the prompt in, whatever.
I'm a literary freaking genius, yeah.
All right. So anyway, the question is, when you work for a partnership, I mean, let's face it, without getting into the details of this case for a moment, if the four of us, again, volunteer here, formed a partnership, and I worked 3 times as hard as these folks, but we all split profits 25%, you might say, gee, someone assigned his income to the other 3 because he's working doubly or triply as hard. But Congress and the code sort of said, you know what trumps? The partnership arrangement or the assignment of income arrangement? And we know the answer, right? That the assignment of income doctrine is going to take second place here, right? That this judicial doctrine is not going to be as powerful in this context because The assignment of income doctrine typically is invoked in the context where there's a perception of abuse, right? Everyone agree that the IRS uses it where people are trying to game the system. And in a partnership arrangement, it's sort of the vicissitudes of who's working harder or less hard. We worked out our economic arrangement. It wasn't driven by tax motivation, right? We were each going to bring something hopefully useful to the table, and as such, the tax consequences will fall where they may fall, and the code and Congress are generally going to respect it. So the point in general about the assignment of income doctrine, and in particular about the Schneer case, is the assignment of income doctrine is not going to rule the day, okay? And as Ashley was saying, perhaps this case is repetitive because we have a person who performs services for one partnership and it's going to join another partnership, and some of the income the person earned at the prior partnership is now going to be assigned to the new partnership, but it's going to be assigned, but he still has to perform services so that the, I'll call it partnership number 2, receives the income from partnership number 1. And the IRS was arguing that, gee, this is really his income. He's assigning it from the first partnership. He should be taxed. It shouldn't be considered income of partnership number 2 and allocated in accordance with the terms of partnership 2. It's sort of, I'm going a little far-fetched here. If you recall Code Section 704C, and if you bring appreciated property to a partnership, the person who brings the appreciated property should be taxed on the built-in gain or built-in loss. Well, similarly, if you bring the expectation of income that you work for a prior partnership, and now you're bringing that income or the potential for that income to partnership number 2, heck, maybe you should be taxed on that. But what do we learn vis-a-vis the Schneer case? Is that going to happen? No. And that becomes an administrative chore. Look, there's many, many pages that go through all this issue. We're not going to spend a lot of time on this. This is really not, in my opinion, going to come up in anyone's practice, in my opinion. It maybe loosely could be, but what's your takeaway from the entirety of this case? Is this the perfect, I mean, there's dissenting opinions and all that, but notwithstanding the dissenting opinion, this case was decided now close to 20 years ago or more. What was it decided? I forget which year. 91? Boy, the years go on. Quite a quarter century. This has not become controversial in its aftermath. So you might say that maybe it wasn't the tidiest of opinions, but it has served us well. This is, ever since the tax court issued this opinion, this has not been high on people's radar screen as an issue. What's the message again? Do not worry about the assignment of income doctrine insofar as it relates to partnerships, all right? Easy? Easy. All right, moving on. Taxable year, okay? Taxable year. There's a test. There's a test. Where's this test found? Code Section 706. Remember, with a partnership, generally with corporations, by way of contrast, corporations can have a calendar year or fiscal year. Because of the problem Congress perceives about taxpayers trying to defer income, and deferral to me is not, I personally, were I Congress, wouldn't be front and center because of the way, estimated taxes work this day and age. It's not that easy for taxpayers to defer income, particularly again because of issues of the need to pay estimated tax. But Congress has a pretty strict regimen, when it comes to deciding what are permissible partnership tax years and what are mandatory. And these rules are spelled out in Code Section 706B. Okay, everyone have the code open, Code Section 706B. And if you look at Code Section 706B1, capital letter B, there's a series of rules that you take in the order presented. Series of rules, take in the order presented. And these could lend themselves to good exam questions, right? You know, what is the tax, you know, what is the partnership's tax year, right? Easy enough. So just be forewarned, just like I said in the second chapter, you know, I could ask, what is the inside-outside basis? Similarly, you know, what is the partnership's tax year? Well, first and foremost, the majority interest taxable year. The majority interest, that's spelled out in one little I. If you look at B4, it defines what is the majority interest taxable year. The term majority interest taxable year means the taxable year, if any, on which each tax date constituted the taxable year of one or more partners having an aggregate interest in the partnership profits and capital of more than 50%. Everybody see that? More than 50%. If the aggregate interest exceeds 50%, they have the same year ending, that's going to control. Rule number 2, if you don't have that, then the default rule is 2 little I. If there is no taxable year described in Clause 1, the taxable year of all the principal partners. Who are the principal partners? If you look at B3, for purposes of this subsection, a principal partner is a partner having a 5% or more interest. So that's default rule number 2. Default rule number 3. If there's no taxable year described in Clause 1 or 2, the calendar year, unless the regulations prescribe another period. And they do. They don't say just use a calendar. They actually say least aggregate deferral. I'll repeat. They require least aggregate deferral. Now you might say, rightfully so, what is least aggregate deferral? And for this, you really need to open up to the regulations, if you don't mind me doing it. If you could, open up to your regulations under 706-1B. Okay, everyone open up to 706-1B. And if you look at 706-1B3, 4 little i's under examples. Everyone have that? So 706-1B3, 4 little i's, example 1 and 2. Everyone have that? Depending on which volume of the code, this is the 2017 edition, it's on page 1378. Okay? Everyone have example 1 and 2, because if you don't, if I just say the word least aggregate deferral, it's going to fall on deaf ears. You got to look at these 2 examples. And if you look at these 2 different examples, what is required of least aggregate deferral is that you go through 2 different testing dates. Everyone have example 1, example 2? It says partnership P is on a fiscal year ending on June 30th. Partner A reports his income on a fiscal year of June 30th, and partner B reports on a fiscal year ending July 31st. A and B each have a 50% interest. So if you picture, you have two partners, one with a year ending June 30th, the other one ending with a year July 31st. The question is, in this circumstance, which tax year will produce the least aggregate deferral? And if you look below, there's two testing periods. The first is June 30th, and it produces a least aggregate deferral of 0.5. If you look at the outcome there. If you test 6/30, least aggregate deferral is 6/30, there's only a 1/2 month of deferral, half a month of deferral. In contrast, if you use July 31st as the measuring month, year end, what you end up with is 5.5 months of deferral. Which one produces the least aggregate deferral then? June 30th produces the least aggregate deferral. Everyone see that? And if you don't, that's okay, because you put in a tough Wednesday before you came to class, and maybe some of you didn't have a chance to look at the regulations. But over the next few days and over the weekend, what better way to do it than to look over these regulations and try. I would not ask a complicated exam question, but just make sure you understand what is the least aggregate deferral. It really involves that you go through at least two different testing periods. The point is, do not just presume it's the calendar year. It is not just default to a calendar year. All right, so we have 3 different tests so far. Test 1 is majority ownership. Test 2, principal partner. Test 3 is least aggregate deferral. Test 4. Test 4, do you have a business purpose? Because if you have a legitimate business purpose to use a particular calendar, a particular year end, you may use that. I repeat, if you have a particular business purpose, and they give two different, under business purpose, two different options. One, you have a natural business year where 25% or more of your receipts are during any two calendar months. Or, I should say, it's a natural business year. If 25% or more of the partnership's gross receipts are earned in that last 2 months, it's a so-called natural business year. Or there's the fact and circumstance test. Why do you think you have a legitimate business purpose? So I repeat, you have 4 different tests. You have test 1, majority. Test 2, principal. Test 3, least aggregate deferral. Test 4, business purpose. Under business purpose, you have 2 different options, a natural business year or fact and circumstance. And a 5th and final option, you can elect under Code Section 444. I'll repeat. Under Code Section 444, you can elect up to a 3-month deferral. If you do make this Code Section 444 election, you have to pay a tax deferral charge under Code Section 7519. There's a tax deferral charge. So some taxpayers opt to get a 3-month deferral, but it doesn't save them any tax because you actually have to prepay your tax for the 3-month deferral period. It's under Code Section 444, and the tax is paid under Code Section 7519. The authors in a footnote go through an example. The point is there's several different options here that you can consider. Dale?
Is it difficult to establish a business purpose?
I don't know if it's difficult. I mean, one business purpose you can't argue, and I'm going to say the obvious, but you can't tell your taxpayer, here's your business purpose. I'm very busy during this time of the year. I'll charge you less if you end your your partnership year, say in June when I'm less busy. That will not be a legitimate business purpose, okay? Because many people in this room might say, gee, I'd love to put this partnership tax return on the fiscal year of so-and-so because that's when I'm not busy. That doesn't fly, okay? So if the people come to you and they have real reason why, probably will fly, all right? I think it will fly only because, like, the IRS has bigger fish to fry. If you really, yeah, that's why I'm saying I don't. But you should document it and have a real reason. And I don't think you want to just, like, every other year decide you have a new business purpose of when, you know. All right. All right. So, guys, just because time is not our friend, let's go through page 76 just to make sure we're on the same page here. What taxable year must partnership adopt under Code Section 706B in each of the following alternatives, unless to the contrary, assumed partnership is newly formed? So suppose all partners are calendar year taxpayers. If the partners believe the partnership will have substantial income, and they were free to choose, what would they select as their, what year would they select? If they expect the partnership to have substantial losses. So, putting aside the questions that follow, if everyone's a calendar year taxpayer, what tax year must you select, guys? It has to be a calendar year because the majority owners, heck, 100% for all calendar year, you got to choose a calendar year, right? If you had your druthers and you could, what year would you select if you were at liberty to select any year? And ignoring the issue of estimated tax payments, what year would you select? Ending when? January 31st, right? Because you can earn a lot of income, okay? And that would give you maximum deferral because you would only have to report that income, right? Your year closed January 31st, so income that you earned, say, from February 1st on, you could delay for almost 2 years for reporting because it wouldn't, if you earn the income, say, in February of 2017, okay, what is that reportable for your clients? Remember, the year wouldn't close until January 31st of 2018, right? So the people who say April 15th of 2019. Okay? Plus extensions. But I mean, you still. But the point is, if you could defer it, you would choose January 31st. If you had losses, when would you choose to end it? You would want to end it calendar year because you want the losses as soon as possible, right? Everyone agree? So, your answer for your notes is December 31st, but if you want to achieve maximum deferral, January 31st. If you want to secure the losses ASAP, December 31st. Question B. Partnership has a 20% corporate general partner, which uses July 31st fiscal year, and 20 individual 4% limited partners, all of whom are in a calendar year. What year must we do and why? What rule controls here? Majority. Okay? Majority. We have 80%, right? 80%. The majority here is 80%. Last I checked, 80% is more than 50%. Everyone agree? Therefore, the year must end as a calendar year. Question C. What results in B above if the first day of year 4, 10 of the limited partners sell their interest to the corporate general partner? So, what will be the year then? July 31st, right? Because then July 31st we'll have the majority owner again, right? Will be 60%, right? 60% owner as of July 31st, right? So your answer for question C, July 31st. Question D. What results in B above if 10 of the limited partners use September 30th, the other 10 use calendar year? So we have lots of dead dates going on here, right? Because we have the corporate general partner using July. So we got 3 different dates going on here, guys.
Stay with you?
It's C, where they sold near Fort. Partnership have to change immediately, or is there?
No, you have several years. You can, if you're using majority interest, you have several years before you have to make the change. If you look at 706 B4 capital letter B, you don't. Every time you have a majority interest change, you don't have to change. But I'm just still for our purposes, just want to point out question C that our answer would be July 31st. Question D, what's the answer? Are we in majority rule? Do we have majority rule anymore? No.
Test 3? We'll use test 3.
Don't skip. What is test number 2? Do we have a principal partner here?
Yes.
And when is the principal partner? July 31st, right? We have a principal partner, July 31st. Everyone agree? So don't skip them, Mark. Rule number 2. Okay, don't skip it. Question E. What results in B above if partnership wants to adopt a September 30th fiscal year under 706B in order to have sufficient time to gather tax information for its calendar year taxpayers? And Dill would say, is this a go? Can you do that just because you want to? Is this a business purpose?
No.
No. Everyone agree? This is not a legitimate business purpose. Can you make an election under Code Section 444? Sure. But you have to pay a toll charge, right? Under Code Section 7519. All right? So this is not, emphasis on the word not a legitimate business purpose. Question F. What results in B above if over the prior 5 years the partnership had been in the rental business and does 20% of its annual business in December, 10% of it in January and post-Christmas sales? Partnership has been using calendar year, wishes to change to January 31st, and do so, if so, does it have to pay a toll charge? Say again?
National business?
Yeah, natural business here, right? And as such, it constitutes a legitimate business purpose, and as such, right, it can use January 31st, right? Everyone agree? And it does not have to pay a toll charge. Now, let's talk for a few minutes about the next class. Don't close your books that quickly, okay? Let's talk. Let me try to give you a handle on some of this stuff. All right, so what we're going to be looking at is, or are the tax consequences to the partners, okay? And we've looked at some of this stuff and things that have to be separately stated and not. And just call to your attention, if I may, if you turn to your, just at the very end of your book, on page 517, there is a K1, okay? The partnership files a 1065, that's a partnership tax return. And every partner gets a K1. And I'm just calling this to your attention because this is where each category of income gets broken down, vis-a-vis this K1. All right, so just call that to your attention. Now, we're going to look at that and we're going to see what things need to be separately stated, which don't. Now, beginning on page 80, remember, you guys have heard me, most of you have heard me, when it comes to income, right? Gains must be realized and recognized. Everyone agree? Gains must be realized and recognized. But you know that when it comes to losses, there's a third finger, right? And the third finger is what? Allowed, right? Everyone agree? Losses must be realized, recognized, and allowed. And there's several code sections which allow losses, but there's several code sections that disallow losses. So we have loss disallowance rules sprinkled throughout, and we're going to see that to get a loss, we are going to have to pass 3 hurdles. Not 1, not 2, but 3 hurdles. Hurdle 1 is what? We have to have adequate basis. Okay, hurdle 1, adequate basis. Hurdle 2 is what? At risk. You actually have to have something at risk. If you don't have it at risk, you can't get the loss. Item 3 is what?
Allowed.
Say again?
Allowed. Be allowed.
Well, to be allowed. Well, it can't be passive. Passive losses are not allowed. It's got to be active. Okay, so passive losses. So we have 3 different hurdles that you're going to have to jump through, or your client's going to have to jump through. So we're going to look at the basis rules under 704D, the at-risk rules under Code Section 465, and the passive activity loss rules under Code Section 469. So those are 3 new code sections that you're going to have to handle. Okay? So we're going to look at those rules, and then we're going to begin code section, beginning chapter 4. We're going to look at partnership allocations, because chapter 4 is pivotal to this course. Why is it pivotal? Because it's what separates us from any other business entity. Code section 704 permits the flexibility that no other business entity has. S corporations, as I said, can only have 1 class of stock. C corporations, by their nature, are much more restrictive about you can get dividends or you don't get dividends. What we'll see when it comes to 704 is that there is complete flexibility with allocations. Now, guys, heavy-duty reading, I'm not sure how far we'll get. We're definitely going to finish chapter 3. Chapter 4, who am I to stop you to read up to page 135? I just don't know how far we'll get. All right? But I can't stop you from reading ahead. So listen, I hope you have a busy weekend. I hope you have a productive weekend. I hope I'll see you here on Wednesday.